Most people think making money from real estate means a down payment, a mortgage, tenants, and repairs. But there's another way, one that pays you every single month without ever owning a single property. And I've actually just started building a position like this myself. Later in this video, I'll show you exactly what I bought, including how I'm allocating my first $1,000. And once you see it, it changes the way you think about investing in real estate entirely. It's called a REIT. A REIT, or real estate investment trust, is simply a company that owns income-producing real estate. When you buy a share, you own a piece of their entire portfolio. Retail stores, warehouses, medical offices, all generating income with no tenants to deal with. You buy it in your brokerage account just like a stock, and you can start with as little as $10. But here's what makes REITs different from a regular stock. They are required by law to pay out the majority of their income back to shareholders. So when their tenants pay rent, you get a piece of it. And unlike most investments where income is secondary, with REITs, income is the point. Now, I'll be honest, I was an ETF investor for a long time, and I told myself I didn't need anything else. My portfolio was growing, and my dividend ETFs were paying me. So I stuck with what was working. But the more seriously I started thinking about retirement income, the more I wanted to diversify that income and add something that paid me every single month, not just every 3 months like most dividend stocks. And that's when REITs started making a lot of sense. There's a small group of them that pay monthly, just like rent, except you're not the landlord. And when you start thinking about income that actually has to cover your life, your bills, your mortgage, your monthly expenses, getting paid every single month changes everything. Now, here's where most people get it wrong, and I want to make sure you don't make this mistake. Chasing the highest yield is usually how people get burned. You'll also hear a term with REITs called AFFO. All that really means is the actual cash flow the company has available to pay its dividend. And that's what matters, because a high yield doesn't mean much if the income behind it isn't strong and consistent. So instead of chasing the biggest number, I focus on consistency. And I want to show you exactly what that looks like in practice, because I actually just put $1,000 into 3 monthly paying REITs. And I'm going to pull up my actual account right now so you can see the real positions. The first one is Realty Income, ticker O, and this is where I put the largest piece. I started with $500, but I'm actually up to $550 invested into this REIT so far. This REIT actually call themselves the Monthly Dividend Company, and that's not just marketing. They own over 15,000 commercial properties, mostly leased to large, stable tenants like convenience stores, pharmacy, and major retail chains. These are long-term leases, which creates predictable income. The yield is currently around 5.2%, and their AFFO comfortably covers that dividend, which is a big part of why they've been able to pay monthly for decades and raise that payout for 32 consecutive years. It's not flashy, but it's incredibly consistent, and that's why this is my largest position of the 3. The second is Agree Realty, ticker ADC. I put $300 here so far. This one focuses on essential retail, grocery stores, home improvement stores, and other businesses people rely on regardless of the economy. What stands out is tenant quality and discipline. They're very selective about the properties they acquire, which helps keep their income stable. The yield is around 4.1%, but that's often the trade-off for higher quality and more predictable income. The third is Healthpeak Properties, ticker DOC, and I put $200 here. This one focuses on healthcare, real estate, medical offices, and life science buildings. It benefits from a long-term trend that isn't going away, an aging population that needs more healthcare services. The yield is higher here, around 7.4%, which is why it gets attention. But it's important to understand the trade-offs. The dividend history hasn't been as consistent as the others. So if steady income is your top priority, that's something to think about. That's why this is the smallest position for me. I wanted some exposure to the higher yield, but I sized it accordingly. Now here's what this actually looks like in real numbers, because this is where it gets real. That $1,050 I've invested so far, spread across these 3 positions at current yields, should generate between $50 and $60 in dividends this year, paid out monthly. Not life-changing on its own at all right now, and honestly, that's not the point. This is just the start of something, not the finish line. Here's how I think about it. Every month I add to these positions, and every month the dividends come in and get reinvested, buying more shares which generate more dividends, which buy even more shares. It's a slow build, but that's exactly how it's supposed to work. That $52 this year becomes $104, then $208, and it keeps compounding from there. And that's the whole idea. I'm not buying REITs because I need the income today. I'm building this position now while I still have time, so that by the time I actually do need it, when I retire, it can cover real expenses, a mortgage payment, a car payment, monthly bills. It's already there, already built, already paying me. You don't wait until retirement to start something like this. You start it now and keep adding to it and let time do the heavy lifting. Now, at this point, this probably sounds almost too good. Monthly income, real estate exposure, no property management. So, what's the catch? Because there is one. And if you don't understand this part, you can make a big mistake. REITs are sensitive to interest rates. When rates rise, borrowing costs go up and prices can fall, even if the properties are performing well. They can be volatile, just like stocks, and their dividends are typically taxed as ordinary income, not at the lower qualified rate. So, where you hold them matters. For me, I hold them in my Roth IRA to be more tax efficient. REITs are not replacing my core. My core is still built around broad market ETFs, VOO, VTI, SCHD, and QQQM. That's not changing, but REITs add another layer, not just growth, but consistent monthly income. And as I get closer to retirement, that distinction is starting to matter more and more. I'm not there yet. I still have time before I actually need these investments to support my life. But that's exactly the point. I'm building these positions now so they have time to grow, compound, and eventually turn into something that can actually replace a paycheck. If this was helpful, make sure to subscribe. I put out new videos every week on building real wealth with ETFs and income investing. And drop a comment below. Are you holding any REITs right now? Or are you like I was, all ETFs and no real estate? I read every single one. And if you'd like to learn more about investing in REITs, I created a free resource that's on my Patreon. It's absolutely free. You don't even have to sign up to get it. I will put a link in the video description if you want to check that out. If you want to see another video about an income producing asset that I own and pair with REITs, check out this video about SCHD right here and how much it would take of that ETF to retire tomorrow. Take care, and I will see you next time.